Alright guys, this video is going to be an absolute banger, so make sure you have the time. If you don't got the time to watch this, put it on your save video list or favorites or something, and come back when you have time to get a drink, sit down, relax, and look at through this analysis. This is going to be mostly a numerical analysis. I'm going to talk about their financial statements, on their annual reports, their data, dividends, financial situation, resiliency. I'm going to cover, some price actions, their, products. At least I'm going to touch on that a little bit, and all in the goal of finding out whether the recently renamed Mercedes-Benz Group AG is worth your money as an investment, and more importantly, will it survive the next downturn or recession? Now, I'm going to start with a brief overview of the company. Okay, so this company used to be called Daimler, and or Daimler-Benz, Daimler Mercedes, whatever. But now they've decided just to go with the Mercedes-Benz Group AG because everybody knows Mercedes, and not many people even know who or what Daimler is. So this is their website. Just a quick overview of their products. These are their vehicles here. They have a ton of EVs coming out. Now, look, I did videos on all the car companies basically right now. I've done Stellantis, I've done GM, I've done Ford, I've done Tesla. Okay, I even did Fisker. So if you want to check those videos, I'll try to put the links on them into the comment section below or the description of the video if you're interested. But this is about Mercedes. So let's go into the product line here. Now, I'm not going to go into specific specs. I just want to point out that they have a very vast, offering. And it's not just Mercedes that this company offers. They offer other brands, under their whole umbrella. But this is basically, the flagship brand of the company. So you can get an idea of what they're offering here. The EV start at like $52,000 for their kind of compact SUV, I guess. The EQS sedan, which looks really sleek, is $104,000. So, the price point for these vehicles is pretty high. They're a luxury car maker, so it's to be expected. They have a vast array of SUVs. First one starting at the GLA, starting at $37,500. I'm not going to go into the specs. You guys know that these vehicles are good. The tech is top notch. Their drivability is good as far as I can tell. Every Mercedes I've been in drives smooth as butter. Their brand, their vehicles are awesome. And also, I have some charts at the end, by the way, that I want to share with you. By the way, that A-Class, how sweet does this look? Actually, not that sweet from this picture, but anyway. So I have some charts at the end that I want to show you. So if you want to skip through to the fun part, you can just skip right at the end. Okay, let's go into the stock overview of the company now, all right? So first, price action. The stock is symbol is MBGYY. The reason why it's got the YY at the end is because this is an OTC stock, guys. OTC means over the counter, which means that you can buy it directly from bank to bank, but you cannot trade it on a US exchange. You just can't do it. And that was one of the frustrating things because I want to take a look at their 20F. 20F is a filing that foreign companies are required to file with the SEC, I think, that lists all their financials in a US style format. And it's easy and familiar for investors and analysts to read in the US. However, they don't have to file one because they're not listed on our exchange. Doesn't mean you can't own the stock. You can, but not through the exchange. All right? OTC. But if your brokerage will do it for you. So whoever you're with, I don't know, E-Trade, IBKR, TD Ameritrade, Robinhood, everybody will be able to buy this stock for you. So don't worry about too much. If they don't offer it right away, just call them up. I'm sure they'll do it for a fee. All right, back to the price action. So this is as far back as it goes, 2011. There's even a chart tab here, but it's actually a little bit harder to read than the one in the beginning because I guess I can get rid of these moving averages. But for the most part here, the stock has been climbing very, very slowly. From 2011, it looks like it's almost about the same price. Okay, it's got like a 1% increase in 10 years, 12 years. But that is not the main reason to own the stock. The main reason is that it pays a fat dividend. Now, this dividend this year is way fatter than one might expect. If you shift your eyes over here to this 28.44% dividend, you might be amazed, but that is just a one-time, one-off dividend. Just to clear things up on the dividend right now, this is a brief history of the dividends. A lot of the OTC stocks pay out annually or biannually, means one or twice per year. This stock happens to pay out once per year. So you can see the 2014, 2015, 16, 17, 18, 19, 20, 21, and 22, they release a single dividend. Based on this dividend, before 2020, we all know what happened in 2020. 2018, they were having a dividend of about 3.25 to 3.65 euros, which means that just with about 6 dividends or 6 years, you could have had your entire investment in the company paid off. Straight up. Okay, so that makes it pretty attractive here. 6 years to pay it off, and then any money you come across from then on as a dividend. So if, let's say I bought a bunch in 2015, this $5 dividend here, or €5 dividend, would be just bonus. Now keep in mind with these dividends that you may have to pay foreign tax fees on them when you receive them, so that might be a little, something to consider. Also, there's a risk, there's a currency risk. I may or may not talk about it at the end of the video, as you see in the lower left corner here. Okay, that's the agenda. So that's what I'm going to be kind of going off today. That's the dividend. Next, on the overview, we can see a PE, okay, price to earnings ratio of forward PE. Those are actually kind of somewhat accurate. Shares outstanding, etc. But we're going to go into more depth. All right. Financials. Quarterly. The reason I like to look at quarterly, because you get a little more definition into the financial statements here. Income statements. Revenue. Look at this revenue. Okay. Pretty flat all the way through. 41 billion for this latest quarter, so about 40 billion a quarter in revenue. Next, I like to look at operating income. Okay. How about net income? 4 billion, okay, about 1/10 of the revenue, 4 billion per quarter, roughly. They had an outstanding quarter in 2021 in December, but we're not going to look at that. It's a one-off, so we're not going to look at that. It's probably where the dividend is coming from. By the way, I want to talk about that dividend, and I'm actually very upset at that dividend. You may fault me for this, and you may argue with me, and if you are arguing with me over it, please leave in the comments and tell me why this was a good idea. But I will probably vent about it when I talk about assets and liabilities of the company. So net income about 4 billion, or 1/10 of the revenue, looks like on average here. Profit margin is around 10%. That's pretty good for a car company. Moving on, statistics. Okay, glaring hole right here. Really upset at Mercedes for this. I don't know if I'm going to have my rant here or later, but $142 billion in enterprise value, which means that's how much the company's worth, but it's trading only for 78 billion. The reason is, the price of the company is 78. The reason is because the difference is expressed in debt. So if we quickly scroll down through the balance sheet, you'll see that the net cash position of the company is negative $64 billion. Negative $64 billion. I'm actually not even sure if that's in euros and dollars, but whatever. They're about the same anyway. That's a lot of debt. And so immediately when I saw this, I'm like, oh, they must have their own financing wing. And guess what? They do. They have financing. Mercedes does their own financing. And look, this is when I'm going to have my rant. Okay. I have a problem with companies having this. Yes, it's a strength in one way, but it's also a weakness in a different way. I had this rant with Ford and GM. They both do this. Okay. They're big companies and they both have financing wing or wings. The reason why it might be good is because it provides a fluid, seamless financial operation of the company. They can always tap their own wing for needs, financing needs, etc. They can finance their customers easier. Everything is synergetic and it works. It flows. Whenever they have a deficit, they can quickly borrow at a little or no cost from their financing wing and pay themselves the extra interest. And that's so awesome. However, it's also a weak point. In a downturn, okay, in a recessionary period, in economic slowdown, all those synergies and gains, they reverse because it was so easy for them to get financing. Now look what's going to happen, right? They're stuck, their finance side is stuck with a ton of liabilities that they may not be able to pay off because their asset side of the equation, and we're going to look at the assets and liabilities in a second, has shrunk, okay? Or sometimes you could even have. So here they are having to pay off, however many, 60 some billion dollars, and then they only get 30 billion to pay that money with, and their liabilities never get decreased. They could renegotiate, I guess, but that's basically default. You're talking about default. Now their corporate bonds suffer, and how is this company going to get financing in the future? Anyway, so that's my rant. My rant is that I hate it when car companies do their own financing because not only it works as a leverage to the company on the upside, but also on the downside. The fact that no one seems to touch about this is that their clientele is 100% correlated with the clientele on their car side. So not only are they getting leverage from the financing side of it, but they're also getting leverage or 2x. They're doubling down basically on their customer base. So if a cyclical period occurs where car sales just decrease for whatever reason, let's say a pandemic, all right, or something happens where they just have a few years of slow car sales, the entire company gets impacted and is very unlikely to survive unscathed. Okay, I predicted that companies like Ford or GM might be in more trouble. Well, actually, Ford will be in huge trouble if that happens. Next up on the list is GM, and this company is probably third on the list of having to be in huge trouble. All right, so that is my rant here on the whole finance wing side of things. All right, let's take a look at a brief statement of their balance sheet to kind of figure out, start to put the picture as to what exactly I mean. Cash equivalents 24. Okay, let's just look at the total assets. Total assets 260 billion. Total current assets 102 billion. Okay. Let's compare the total assets 260 to total liabilities 173. So that leaves us with shareholder equity of about 85 billion. Okay, fine. The company is currently worth 77 billion, so 85 billion is not too bad. Not too bad. They have about a negative, 15 billion call option, so that's fine. Now, I, of course, could not find the 20F because it doesn't exist. So what I did instead was looked at the 2022 annual report of the company. So I found it and skipped through 200 pages of nonsense to find the assets and liability breakdown. Okay, so here it is. For those of you on a desktop, you'll be able to read this because it should be on HD. However, those of you on the phones, I'm sorry. You're just going to have to listen to my voice and try to go over the figures here. So a few things that I want to bring to your attention. You can read through this yourself if you want. Okay, it's group.mercedes-benz.com/document/investor/report/annual report. slash Mercedes-Benz, etc., etc. You're going to find it somewhere in there. So from their main site. A few things I want to bring your attention to. Okay, the biggest numbers. Equipment, right here. Receivables from financial services, $48 billion. All right. Equipment on operating leases. This is also a little concerning. They do a lot of leasing. Now, I don't know, I'm not an expert on auto business. If you are, please let me know. And this came up a lot on the annual report, these leasing figures. Is this normal? Like, I know that Europe is kind of big on machinery leasing, but is this like financially viable? Why don't they just, build their own machines? Do a little like vertical monopoly or something. I don't understand this whole leasing of the equipment thing. I really don't. Maybe it's more valuable because it's more flexible. If you're a car industry guy, please leave in the comments below. Why is this advantageous for Mercedes? Okay. Receivables from financial services, guys, $48 billion. $48 billion. Total non-current assets, 157. So we have on the liability side, right? And right here, receivables from financial services, $37 billion. On the liability side here, look at what we got. Financial liabilities, $62 billion. So this side is hard, okay? It doesn't change. It doesn't adjust down if the currency goes up, let's say, or there's a economic trouble, like a meteor or something strikes a country. And sorry, I shouldn't be laughing about that. Or a nuke. I'm totally serious, not laughing. And their asset side, for one reason or another, disappears. And so they're stuck with these liabilities. Right? Financial liabilities. Look at this. $62 billion. All right, let's scroll down a little further. Look at this big number, $49 billion. Financial liabilities. Okay? These are basically, money that they have to repay. A lot of them are short-term. A lot of them, I don't know the exact breakdown, but a lot of them is basically money that they've borrowed that they in turn lend on to their customers or to their own company for one need or another, and they have to be repaid. It's big numbers, and here's why I don't like this one-off dividend. All right, this is when I'm going to have my rant about the dividend. The dividend of €5. So the stock price is like 18. Okay, let's call it euros. I think it's in dollars, but whatever. Let's call it euros. €5 out of 18, that's huge. That's a big percentage of the company, right? Hello. I understand that banks and finance institutions are, can be kind of independent, and they borrow at low rates and they'll lend at higher rates and collect the difference. That's the whole point of financial institutions. But are there rules that's stopping them from using that windfall from 2021 to just bring down their debt a little bit? I know they have been bringing down the debt, okay? If we look at here, let's go to the financials balance sheet and, let's go to quarterly for the definition, and we go to total debt. So total debt, look what's going on with the total debt. All right, let me see if you can see it clearly. You should be able to see it. Total debt in 2020, right? It went up from 40 billion to 106 billion. Then it's been coming down. They've been paying it off, thankfully. All right, but why not knock off a big chunk of that and become the company that you used to be, where you're only holding a little bit of net debt, or at least a reasonable amount of 30 billion, 40 billion. What is this $82 billion of debt doing there? And why you got to pay the money out to the shareholders, right? Because what happens is, the reason I don't like it is because when you pay the dividend to the shareholders, now, yes, they're getting some of their money back, but now the company that they're holding is weaker and more fragile and less able to keep turning cash, because that interest is going to always weigh on them in the future. And interest, by the way, is not that little anymore. It's not like they're getting all that debt at 0%. They can't just keep rolling it indefinitely and hold like $1 trillion on their balance sheet at zero. There are rates now, okay? Interest rates actually exist. They're not zero. So why is this the smartest thing, to just get rid of the money when you need it the most to settle the debt with the highest interest rate? It doesn't make any sense to me. I don't understand why they would do that. That's what pisses me off about these companies. Like, I would like to invest in this company if they were doing something like that, but they don't. Why not just pay a smaller dividend again? Settle some of this. Are there rules against it? Do European companies, are they required to have crappy balance sheets in order to stay listed or something? It's ridiculous. If you're an expert on the European equities, tell me why this is a good idea. I just can't see it. I don't see it at all. One thing I forgot to check. I'm heated now. One thing I forgot to check here on the income side is I want to look at their common stock. It's a little bit different for this for foreign companies. I want to see shares outstanding. I don't think they're listed here, unfortunately. I don't see shares outstanding diluted. That's too bad. It's too bad. Anyways, what I wanted to find out is whether or not they are selling down. They're selling shares or buying shares up from the company and trying to, dilute or concentrate the ownership per share for the shareholders. That was one of my intrigues. Okay, this is the net cash versus over debt ratio, and you can see that they're not really making that big of an improvement. So I'm a bit mad. All right, this is the website on their financing wing here. They do leasing versus financing, insurance, protection, payment estimate, and online credit applications, etc. Auto pay, whatever. So I looked into it a little bit, and yes, they do offer. So I do know they do financing themselves. So did notice that. Now it's time to do. Let's see what's next on the list here. Asset liabilities. Okay, stat valuations, we did that. Asset liabilities discussion, we did that. Currency and OTC risk, we kind of mentioned it. I mentioned what OTC is, over the counter, right? They're not listed in U.S. exchanges. They're not allowed to abide by different rules and regulations by our own financial system for, reporting purposes, etc. So there might be some things on the annual reports that are not necessarily clear. There may be some hidden things that are not mentioned. I did read kind of through the report and noticed that they have part ownership of some companies like Denza. They have like 10% ownership of that. It's some kind of electric auto manufacturer somewhere. And then another company called ACC that I haven't quite frankly looked into what it does. It's probably some kind of automotive technology company. But I'll leave that up to you to figure out what they are. So they do have some holdings of different companies. It's not uncommon for companies to do. It's usually something that Chinese companies used to do a lot. They all owned a piece of each other. So they kind of move as a unit. The idea is you want to own a little bit of your competitor in case they start doing better than you, your company doesn't go to shit. So that's basically, I think, the idea there. But they've started to actually separate a little bit more in China when it comes to that. But that's a whole different discussion. We don't need to get into that. I just wanted to mention that they do own parts of a couple little companies. Now, currency risk. Currency risk, what does that mean? Well, if you invest in dollars and the company that you're investing in earns in euros or some kind of different currency, then obviously there's a mismatch at the end of the year. When the earnings come in, they have to be translated into dollars. So not only going to be paying potential tax, but there's also the risk that your currency not going to be, your earnings are not going to be as high because of the conversion rate. So you just need to be aware of that. There are ways to hedge it. In fact, the company itself hedges its own currency risk to an extent. You can see that in their annual filings as well. And before I do the conclusion, we're going to look at some graphics to try to figure out what the brand's doing and what its stance is compared to other automotives. Now, last I checked, they hold a market share of about 5%, 5.3% or something like that in the world's vehicles. So it's not too shabby. And the first graph we're going to look at is light vehicle sales in the United States between January and December of 2021 and 2022, last year, by manufacturer. So this is interesting to look at. What I found amusing about this chart is not only who the top 3 or 4 are. So General Motors, Toyota, Ford, and Stellantis are the top 4. Then if you can't read it, it's Hyundai, Honda, Nissan, Subaru, Tesla, Volkswagen Group, BMW Group, Mazda, Daimler, Volvo, etc. So Daimler is Mercedes. Okay, basically. So they are, way far down there, but that makes sense because they're a luxury auto, and they're just about as much as BMW, maybe a little bit less. And then Volvo, Jaguar, Rivian Automotive is on there. Look at that. They sold 14,000 vehicles. Good for them. What I found interesting about this chart, though, is the darker blue line represents vehicles sold in 2021. The lighter blue line represents vehicles sold in 2022. The only company that sold more vehicles in 2022 than 2021 in US was your boy Tesla. 302,000 vehicles in 2021, more than 500,000 in 2022. Very interesting. Okay, next, to take a look at the brand standings of Mercedes compared to other brands, at least in the US, is consumer satisfaction with their light vehicle brands. 2022, Lexus and Toyota is number 1, unsurprisingly. Then surprisingly, it's Audi, Volkswagen. I don't know. Then it's Infiniti, Nissan. It's owned by Nissan, or Audi is owned by Volkswagen. Acura, which is owned by Honda. Cadillac, which is owned by GM. And then it goes Tesla. It's pretty low. I thought it might be higher, but it kind of makes sense. I don't really enjoy the Teslas personally. Don't hate me for that. I've tried them, okay? I'm just not saying that just to be unique. Tesla, Subaru, Toyota, Ram, which is Stellantis, which is Dodge. Mercedes-Benz is pretty low, guys, on the list. Maybe it's because people who buy Mercedes-Benz just have higher standards. I don't know. Hyundai, Mazda, Chevrolet, BMW is way down there. I own 2 BMWs. Not the Mercedes guy, I'm the BMW guy. But I don't mind either. Nissan, Buick, Volkswagen, Honda, GMC. Honda's pretty far down there. I don't like Hondas either. I've been in some Hondas and they're very unimpressive. Bonus, okay? To conclude this talk, this long 30-minute evaluation, picture painting talk, is a fun chart fact, okay? And what this is going to portray is the number of championships in Formula One that each of these brands has throughout the years. You can see that, pole positions rather, not like constructor titles or anything like that. So Formula One manufacturers with the highest number of pole positions of March. The pole position is acquired when after qualifying rounds, whichever brand starts at number 1 in front of everybody else when the race begins. That means they had the fastest lap, let's say, with their corresponding driver and car. That's what pole position means. They start first. So technically, without any competition on the track and nobody to overtake, It's more about the car rather than the driver. It's obviously it's a combination of the two, but the overtaking skills and keeping somebody behind don't really come into play. It's just more about like how the synergy between the driver and the car and how good the car is and the skill of the driver. So it's the best judge for manufacturer and how good they are with their car and the team, obviously the racing team. So Ferrari's had the most pole positions over the years, 242. Then McLaren, Mercedes-Benz actually third, 136. So not bad. So they're very famous, Lewis Hamilton, all that. I don't know if you guys watched the what was it, race for your life or something, Race or Die. I don't know. The Formula One series on Netflix. That thing's good. However, they do. I'm a ex-tennis pro, and they do Breakpoint Tennis, which is kind of like the same type of documentary series. And I gotta tell you, it's not that impressive. I mean, it's not horrible, but it's really not that impressive. The Formula One was way more fun, way more fun. But anyways, I just want to point out that Mercedes-Benz is represented really well here in these brands category and is very, very well known in the racing world. And I respect the fact that they're willing to put their hat in the ring and compete. Right? Just some fun ones here at the end. Maserati's here with 10 pole positions. I didn't even know a lot of these brands. Alfa Romeo is here with 12. Look, have you heard of these brands before? Benetton? Huh? Tyrrell? BRM Cooper? Ligier? Is that how you say it? Van Wall? Curtis Power? Braun, March, Matra, Shadow. That sounds cool. Toyota. Okay, heard of that. Bar, Honda, and Jordan. What is Jordan? I don't know. Maybe those are some really old brands back in the day. But I just thought that was fun to look at. So, anyways, the conclusion is the company resilient? Okay. Well, yeah, it's a large company, and it looks like it has a shit ton of shareholders' equity. So, in when things go bad, I think they will survive, but they're going to take a big hit. I really hate the fact that they have a finance wing just like Ford and GM. And not just that they have it, but it's big. It's not as bloated as Ford and GM, but, relative to the size of the company, I guess. And it's probably better managed, I'm guessing. But it's still, I don't like it. I don't like it. So there's not as recession-proof as other car makers. For example, Stellantis. Stellantis so far has been the best. It also pays a nice dividend. And it's an ADR, American Depository Receipt, unlike an OTC share, an over-counter traded share like Mercedes, which gives it a little bit of an advantage. You can trade it in the U.S. Markets, and they do a 20F financial reporting. They don't have to carry all that debt and risk, and they're very profitable. And did I mention they also do a big dividend? So Stellantis so far I like better than Mercedes. So they're going to survive but get hit in a big recession. They are profitable. I don't like the management of their dividend. I don't like the way that they chose to disperse the extra capital. I would like for them to build more resiliency within the company, but that's just, me. And that's a reason why I wouldn't personally buy the company. But is it profitable? Yes. It's got a decent margin, 10% steady. It makes money. It's not like 1 year they're going to lose, 1 year they're going to make, etc. You're not buying a raw resource company here. You're buying a very solid brand, which is, very well run. They make really good products. And you're not going to go wrong with that. Not going to go wrong with that. If I was forced to buy a car company portfolio of like 5 companies, this would have to be one in there. But if I was forced to buy a portfolio of only 2 companies, it probably would not be in there. Stellantis would be in there, but not Mercedes, unfortunately. So it wouldn't make the cut. It's not top 2 material. It's top 5 material for sure. So those are my thoughts. As with any financial talk. This is, of course, not a recommendation. You need to do your own due diligence and do your own research, and any decision you make about your financial situation is your own, and you have to take your own risk. I would suggest you determine what percentage of your total investable assets or capital is appropriate for you to put into any single company. Diversification does bring some safety. If you are not understanding how these markets work or anything about the markets that you think it's unclear, I'd highly suggest you contact somebody who does know, and not somebody on YouTube like me, but somebody who's been in the industry for a long time and works for a reputable company. That's what I would suggest. At least run it by them before you go to someone else, and maybe get multiple opinions about your own finances. If you happen to sit on some cash and don't know what to do with it, don't just be like buying random stocks. Okay? Don't be YOLOing on call options. Don't do it. Thank me later. Alright, this has been an extremely long video. I know it was a lot. The conclusion was this. It's top 5 but not top 2. Make sure you, if you do decide to invest, you invest the appropriate amount. Make sure you're aware of the risks, like the fact that it's not listed in the United States and there's a currency risk. Make sure that you know that they put a divvy out once a year, and everything I said about their money management, assets, liabilities, stats, valuations, etc. Keep that in mind as you consider this company for investment. And with that said, mic drop.